or whatever you want, put it in the business. In 5 years, I expect you to give me this amount. Okay. So you can have that sort of arrangement. Main good part of this thing is that you share risk equally. You share the gains too equally, depending on the percentage you agree on. So if the equity investor puts money in the business dies off, we all lose. It's not like I owe you anything. We are in this together. So if we lose, that kind of thing. So that's one good thing about equity. Now, debt financing has to do with financial obligations, where the capital provided uh, is sort of attracts some interest after a period of time. So if the person provides whatever or entity provides whatever funding or money that you need, after some time, you're expected to refund this money with some sort of interest, which is very relative, depends on several factors. So now let's look at the equity capital quickly. So you can get this equity from, or the ideal places to get this equity sort of funding from is yourself or the other founders that you have on board. You can get them to commit money into this your venture for you to be able to progress. You can also get your top management team. So usually people that you work with that are of high they have of high repute and in good standing, you can bring them on board to be able to provide some sort of equity for you. You can also get it from friends, family, relatives, and all that. Now, this is usually referred to as the inside equity. Advantages that you have for that is that this is easy and quick sort of source of funding, and there's less pressure with equity. And usually the arrangements might not be too formal. You might not have to do with legalities and all that. Usually you have to do with just some simple agreements, and then you are good to go. And then you also don't incur debt if you go in for this inside equity. But the disadvantage about this is that there could be a risk of destroying your personal relationships with the investor. So after some time, if you are not able to pay, this might affect the kind of relationship you have with the inside investor. Then it can also encourage interference. People think that because they've given you some sort of funding, it could be family, okay? Because they've given you some sort of funding or support, they could just interfere in whatever proceeding that you are embarking on. They could just stop your business at every point in time. And sometimes too, it might force you to make personal sacrifices. Okay, so now people are on your neck, your friends are coming at you because probably they need their money back or something like that, and you are not able to provide or do anything to help. It might lead to you making some sort of personal sacrifices that you might not be ready to do. We can also look at outside equity, which comes from investors who have no personal relationships with us. Okay, so equity investors are interested in the returns that they will get on their investment somehow. So if they are putting money in, what do you promise to give them? You should be able to check all that so that you know how you can deal with outside equity. Now, to be able to finance your business, you need to obtain the risk capital. First, you need to know that whether your venture or your startup really needs this outside equity capital. Okay, you need to check, you need to assess yourself whether you really need to go in for this. Then also you need to check whether you or the other co-founders that you have are really interested in outside equity capital. You need to analyze that. Then you also need to know who you are willing to go to for this finance option. You need to ask yourself whether you are willing to take the risk to engage such a person to help you in your venture. Now, when you are making a presentation to these prospective investors, you need to ask yourself what the market opportunity is. What is the market for your business? What is the market potential for your idea? Why is it compelling? What makes you think that your sort of idea is so enticing or attractive that somebody is willing to part ways with their money just to sponsor you or support your venture? Then also need to ask yourself how your business is going to make money. This is something that most of us fail to do. We are always excited about putting the product out there, putting a service out there, but we don't check whether this sort of business or sort of idea is going to make money. So we need to know how we are going to make money before we can make a good presentation to the investor. So it's not advisable, as we've taught the trainees over the past 2 weeks, it's not advisable to go solo unless you can. If you cannot, you need to get an extra person or extra people to help you to deliver your product to the consumers. So ask yourself if you have the right team before you can approach the investor for funding. Now, what should we look out for before we talk to the prospective investor? You need to look out for investors who are considering uh, or who are interested in the particular stage of your growth. So it's not advisable to be pitching your startup to an accelerator program. You will just waste your time filling the form online and completing every requirement. They might not consider you because the program is for probably businesses that are in acceleration, businesses that are at the growth stage and are willing to scale up. So if you're a startup, you need to know which stage of your business that the investor is willing to contribute to. They also need to understand if this business or this investor that you are going in for can help you with advice, business advice, or they have the right contacts in the business or the industry that you're operating to be able to help you grow financially. Now, let's look at some specific investors, okay, or some specific people that are interested in investing in our business from outside. I mean, this we are still talking about outside equity. So some outside or some current outside equity investors that we have in our times now. Angel investors are becoming common. The guys are out there looking for startups that have the minimum viable products that they can support and provide funding for. So most of these guys or these angel investors are self-made entrepreneur millionaires. And a prominent one in West Africa now is Tony Elumelu. We also have Magdan in Ghana who's trying to support people or entrepreneurs in that regard. Now, most of these guys are well educated, and they sometimes get they have gotten to the peak of their entrepreneurship journey, and they did this usually through their own personal hustles. So they try to support other people who are interested in entrepreneurship to be on their own. So you can look out for angel investors who might be able to support your venture. They have the advantages, of course, and the disadvantages as well. So a key disadvantage is that sometimes these people are overprotective of their investment. So they put money in your business and then they become protective. Like they expect you to do some things their way. Okay, so if you're not able to do that, they might cut the funding or create some problems for you. We can also look at venture capital. Aside the angel investors, the other crop painting is venture capital. Now, this comes from professionally managed investors. Okay, so probably a group of people who have put money together to invest in entrepreneurship or some sort of businesses. So you can look out for venture capital to support your business. Now, they also have their advantages and disadvantages, of course. A key advantage is that they bring additional money to the table, of course, and they also provide additional advice for your venture because these guys are, like I said, they're a group of people or they have contributed a pool of money and then they are people with diverse backgrounds. So they're able to provide business advice for you and your venture while you progress. A disadvantage to here is that these guys are likely to interfere in your company affairs or they can even create dilution in your ownership. After some time, they can just create a dilution and you might end up losing your venture. Now, going public has to do with companies that are scaling, not startups. So I will skip this for now. And then we look at the last part or the last phase after equity, which is the debt financing. Now, it is not easy for you to get funding or to get loans for your businesses because one, your business is likely to be in the startup stage. And that means that you don't have a minimum viable product. You don't have a share in the market for any other person to be investing in you. You don't even have assets to use as collateral for these kind of loans. But then, if you think you qualify to get funding for loans, then you need to evaluate yourself in the following with the following C's. They are called like the 6 C's. Okay, so you need to check one, your character, whether you have the personality to take this sort of funding. You need to check the capital, as in the amount of money you have personally invested in the business. Okay, so now the people are going to check whether you qualify for loans. So they need to know how much you yourself you've committed in this venture of yours for them to be able to help you out. They also need to have the capacity, the management ability of your team as to what your people possess for them to believe that you can really use the funds that you are requesting for. And then you also need to look at the collateral. Sometimes you need to provide security for your business. So it could be anything. Sometimes it's just a guarantor, a person um, guaranteeing that you can settle their loan amounts after the stated period. Again, you can look at circumstances or issues that that's the fifth C, circumstances. So character, capital, capacity, collateral, circumstances, and the last one, coverage. So circumstances has to do with the nature of product or the stage of the competition that you are engaging in. So probably you are having tough time competing with your clients, and then the little funding can make your can scale up your product fast. So if you're able to present this to the loan evaluator, they might be able to consider you. And then the coverage of the loan, whether there is an insurance coverage on the loan that can provide the lender. Okay, so like the guarantor thing that I stated. So probably when you die, I'm not saying you die, but probably when you die, someone is there to cater for the expenses and all that. If you're able to provide this kind of 6 C's, it is okay to be able to get debt capital. Now, debt capital can be in the form of trade credit. Okay, so let's say you are producing shea butter, and then you are a packaged shea butter. It's not like you are making the raw ones. So your source of the raw ones is from the north or the northern part of Ghana. So once you are getting these raw materials from the north, you can have some sort of arrangement, okay, with the supplier so that they can give you these raw materials on credit. Okay, they give you the raw materials on credit, and then later on you can pay off. Okay, so let's say you take the raw materials, you use them, then you pay to take new stock, something like that. You can have this sort of arrangement, and it will be a sort of form of debt, but it is not a loan. Like it doesn't look like a loan to scare you off. Then the other one has to do with commercial banks, which is one of the most difficult things to get in our part of the world. It is very difficult to get debt. To get this sort of funding from commercial banks because, like I indicated earlier, we lack some of the requirements that they need. So it's difficult. And moreover, the idea has not been tested, especially if you don't have the business working. Your idea has not been tested, so there's no way that you can prove to them. You don't have a working business plan to show that you can repay when they give you the funding. Then you can get it from also through factors and leasing. Now, this debt has to do with, or let me say, a typical example is with mortgages in Ghana. So you hear of uh, companies telling you that you can take, for example, laptop and pay over time. Okay, so this is a form of debt. Okay, but it is in an asset or something of that sort. So you take the product or the machine, you use it over time, try to make some money out of it to pay off your debt. So these are all some sort of debt options that you can look out for. Okay. Now the disadvantage with this debt financing is that sometimes the interest rates are very high, especially in this part of the world. In developing countries, our interest rates are very high, and sometimes it discards us from. I mean, it puts some of us young people away because we cannot pay the high interest rates. Then the risks that profits there's high risk that the profits that you are going to make cannot cover for the repayment. Okay, now there's a challenge because this is a big thing when you do your own calculations and then you realize that the amount of money that you are going to get over time cannot pay for this interest, the capital, let alone the interest that this debt is going to accrue over time. So it makes it difficult, to be going for debt financing. Again, the procedure for accessing these loans can be cumbersome and very difficult, which is very true because if you look at the papers alone or the forms that you need to complete